I, I mean, per se, from a global markets perspective, let's get a better sense of how Peter Cardillo, he's Chief Market Economist, Spartan Capital Securities, joining us this morning, is looking at everything with regard to global, given the current environment. Peter, great having you. Thanks for joining us. Good evening to you from where you're at. Let me first start off by understanding from you what you're making of the moves on crude and this kind of assurance that 9 million barrels is actually flowing out of the Strait of Hormuz. Does that in some form or shape surprise you, and therefore should crude be lower? How are you looking at that?
Well, I think that's not the only factor. I think also, what's being basically focused on the market right now is the fact that this week the Department of Energy reported a huge jump in crude oil stockpiles. And that, of course, along with the news that you have that X amount of oil flowing out of the Straits of Hormuz certainly is putting pressure on oil prices. But this can change rather rapidly. I wouldn't be, too quick to say that oil prices cannot reverse and go higher. Look, the war seems to be accelerating. And even though the United States has changed its tactic right now, and instead of using military strikes, etc., they're going to use pretty severe economic, they're going to put pretty severe economic pressure on Iran. So that eventually will work. But in the meantime, that could cause some serious attacks from Iran and the rest of the region. And if that were to happen, you would quickly see the price of oil reverse. Now, would it go to 120 or 140 and stay there? I don't think so. Could it go back up over to triple digits? Absolutely. But I don't think it would be long lasting. So I think you have to really focus on what can happen on a daily or weekly basis, and not necessarily its long-term effect.
Peter, how do you look at the U.S. markets, given the fact that the earnings have been good for the S&P 500, the earnings growth is above 550%, which is coming in. Do you see enough leg for the U.S. Rally?
Oh, I think so. And we're coming. The earnings season basically ends on the 15th, which is basically tomorrow, and it's been a great earnings season. But what's really been the key to this earnings season, and what's made it into a strong earnings season, is the fact that we have guidance that has not been cut back. And in many cases, it's been stronger than anticipated. And I think we have to realize, why is this happening? I mean, the economy is not really growing that strong. We still have elevated inflation. But the corporate tax breaks that kicked in at the beginning of the year are now trickling down to the bottom line. And so I think that will continue. So even if you have growth, let's say, of an annual percentage rate of 2%, you're going to see earnings continue to grow. And that is the basic fundamental of the stock market. So I think, yes, there is another leg upward. Of course, somewhere along the line, you should expect a pullback. It would be only natural and healthy for the market. But I don't think we're headed for any serious corrections that, would basically wipe out the earning, wipe out the gains.
So Peter, still recommending allocating higher to the US equity markets?
I'm sorry, I didn't hear you. I lost you.
No, I'm just wondering, in terms of an investor allocation, would you say that continue and stay put with US equities?
Yes, I would. And, my allocation at the moment would be 60% in equities, 10% in precious metals, and 30% in bonds.
And just very quickly, Peter, with regard to bonds, the bond yield we are currently seeing on the US 10-year at 4.65. You expect it to continue to creep upwards. Where do you see the trajectory?
Well, I think the Fed's hold in September, the two inflation reports that we got, both the CPI and the PPI, were basically tame, modest increases, and the key is no acceleration. Now, of course, inflation still remains elevated, sticky. So I think that, for September we're safe, and there's a possibility that the Feds might also skip in December if inflation doesn't accelerate and if oil prices, because right now most of the inflation is tied to energy. So if you keep, if crude oil prices, let's say, stay within a 5 to 6% margin a margin of prices, then I think it's safe to say that we might not get an increase this year.
Interesting. Peter, always good chatting with you. Thank you for joining in.
Thank you for having me.